So 138, intangible assets. It covers all intangible assets except things in other standards. So financial assets, exploration and evaluation assets, development assets for natural resources. So again, scoping out becomes important. Definitions. An intangible asset is an identifiable non-monetary asset without physical substance. Identifiability is important. It's got to be separable from the business. So things which are internally generated by and large are not separable. Internally generated brand names, like if you've built this up and built this company or internally generated goodwill, this business is valued much greater because of the things that you've done and made work. You can't just sell that goodwill off to someone else. That's not separable from you. And it's the idea that it arises from contractual or legal rights. So buying a license to do something gives you a license to do something. You can often buy those things. It's non-monetary because, I suppose money is, paper itself, the paper money is printed on is not that expensive. So what money is pretty much intangible. And for most of it, it's often just the ones and zeros on a computer screen. But it's this idea that it doesn't have physical substance is obviously important to an intangible asset. Now, we have seen this definition before. An intangible asset shall only be recognized if and only if it is probable that the expected future economic benefits that are attributable will flow to the entity, and that cost of the asset can be measured reliably. So we see this probability, reliability. We see it time and time again with assets, and we see it again here. An intangible asset shall be measured initially at cost. What is cost? Let's see if it's on the next page, and it isn't. We'll come to cost. There are two main types of intangible assets that standard sees. They're the ones which you develop internally, and they're the ones which you actually go out and buy. And I can pretty much guess that you guys will know which ones are more likely to be the ones that can be recognized. And they are the ones we're about to look at now, which are the ones which are separately acquired. So the things we're talking about here are things like taxi licenses, patents, customer lists. We'll talk about customer lists in more detail in a second. Poker machine licenses. You need a license to run a poker machine. So if you've got a pub in New South, well actually in Australia, but if you've got a pub in New South Wales and you walk into one, you pretty much will find a poker machine, or at least one. Unfortunately, you probably find a lot more than that. They're a license to print money, those things. I don't get them, I don't like them. I think if we followed the Whitlams and blew them all up, the world would be a better place. But the thing with poker machines, you need a license to run them. You can't just go out, start up a pub and just go, yeah, I think having a poker machine would be a good thing, I'm just going to buy the machine. It costs about $40,000 to buy the license to run a poker machine. That's just gives you the right to run one in your pub. I know that because, I know it's roughly about that price because the club I'm associated with actually ran into some cash flow problems, and they actually had to sell off some of their licenses, and they were looking to raise about 35 to 40 grand per license. So that's not the machine itself. That's not Queen of the Nile and whatever other ones there are out there. That is just the physical, that is just the intangible license to give you the right to do it. Taxi licenses. You need a license to be able to run a taxi. I drove my car here to work. I can't feel it, I need a bit of extra cash for the weekend. I'm just going to sort of go out into George Street and pick someone up and drive home, say, do you need to live somewhere and drive them? I'm not allowed to do that. Probably a good thing, I probably wouldn't want to do that anyway. I think it'd be an incredibly tough job to be a taxi driver. You know how much taxi licenses are in New South Wales? $500,000? I thought it was about $250,000, but it could have gone up by now. But yeah, it's at least $250,000, if not a lot more. They're expensive things, and you're not buying the car. That is just the license to be able to run the car. So they are expensive. Now, should they be that expensive here? They shouldn't, but there is very much a monopoly going on in this state around taxis. So there's issues there, but you can go off and buy them. The cost includes, and we've seen this before, the purchase price plus directly attributable costs to get the asset ready for use. So that's really similar to what we saw with inventory. It's really similar to what we saw with property, plant, and equipment. So this idea of what assets are and what they cost, we see these same ideas flow through. They know things. That's a bit cryptic. This refers to customer lists. Now, does anyone have a Woolworths everyday rewards card? Yeah? I used to have, well, I actually still do have it. I stopped using it a while ago, just found it a bit creepy. The fact, I mean, they do know things about us. I got a letter after I stopped using it. I still shop at Woolies. I got a letter about 6 months after I stopped using it, asking where I got to, because they missed me and they wanted to have me shop at Woolworths again. And I felt touched. This big, massive, multi-billion-dollar business cared about me, and they don't. They don't actually really care about you. They care about your money. Now, the example I just want to bring up here is some of you may have heard this. Target. Now, Target in the US, this is a story about Target in the US. There was, excuse me, there was a story about Target in the US from a few years back that there was a father received a letter from Target basically congratulating his, I don't know why he opened, well, maybe it was addressed to him, but basically congratulating him on his daughter's upcoming birth. Not her birth, but she was going to give birth to a baby. And he was his teenage daughter, and he was like, what the hell is going on here? Like, she's not pregnant. She hasn't told me. So got on the phone to Target and blew up at them a little bit, and they said, no, it's, I don't know, it should be right. He called back a couple of days later saying, well, actually, no, you guys are right, she is actually pregnant. She hadn't told him, and they were able to figure out before him that she was pregnant based on her shopping habits. They're able to do this sort of stuff. Now, this is not that case. One Target employee I spoke to provided a hypothetical example. Take a fictional Target shopper named Jenny Ward, who is 23, lives in Atlanta, and in March bought cocoa butter lotion. Certainly seen some of that around the house. A purse large enough to double as a diaper bag, zinc and magnesium supplements, and a bright blue rug. There's, say, an 87% chance that she's pregnant and that her delivery date is sometime in late August. Based on your shopping habits and linking that to the cards that you use, they can work this stuff out. Think about where you can use your everyday rewards card. You use it for your petrol purchases. You use it at Woolworths. You use it at BWS. You use it at wherever the hell else you use it. You start linking that to frequent flyer cards. You start linking that to credit card things. This is all getting matched up. Somebody, I was talking about this in the class this morning. Somebody came up and saying they're starting to match this stuff up with what you do with Facebook. This is all starting to link together, which the data is there. At the moment, what isn't there is processing power and understanding how to properly use it, but that is being worked on. They know an awfully large amount of stuff about what we do. And that is valuable. That is incredibly valuable to the business. Now, where this is important, what the accounting effect of this is if this is internally generated, this is something which you do not recognize as an asset. And I should have lined this up earlier, but it shouldn't take too long to find. Give me a moment. Wow, that's really slow. What does it take to bring up Google here? Okay, so this is from just over a week ago. Coles reveals customers' data is shared with third parties overseas. Go on to talk about how if you use your Flybuys cards at Coles, so it's not your Woolworths Everyday Rewards card, personal details are sent up to 30 other companies owned by the same corporation and to third parties in at least 23 other countries. So, and that makes sense. Wesfarmers is a big organization, so that's going to be shared in amongst the group. This information is valuable. They also seem to be transferring it outside of that group. Tesco in the UK, Tesco kind of like Woolies and Coles and all that, they're selling that and they're making money off it. This information is valuable. That's the point. Now, there's an accounting aspect which is useful, but there's also just a real world aspect. Think about Google+. It's linking up under the banner of your Google searching, your Gmail, YouTube accounts, all of these things being linked, so they know all of that information, and that's incredibly powerful for them. You start linking up those accounts with your Facebook, with other social media accounts. You know, it's one of the reasons why Facebook paid $16 odd billion for WhatsApp. It's why it paid the amount of money they did for Instagram. It's why these are all getting aggregated under similar companies, because they have the power of knowing what you do and who you are is incredibly valuable to them. Now, for someone like Tesco, the accounting aspect of it is, even though that customer information is incredibly important to you, that customer list, they do not record it as an asset because it is internally generated. But the companies that they're selling this to, that is an asset for them, and they've paid for it, and it is a separate acquisition, and that would be recognized as an asset, as an intangible asset on the balance sheet. So that's just all I'm picking up there is, it's the same, potentially the same information, but depending on whether you generated it or if you bought it, will have an effect on the accounting side of things. So hopefully not to scare too many people, but they're just something to be wary of. Same deal as if, you know, and especially you guys are second year, potentially third year, if you're in job interviews, I've been reading a lot of stuff about companies will start to, you know, we'll try to add you on LinkedIn, we'll try to Facebook friend you. They, you know, if your profiles aren't locked down, they'll be checking that stuff out. Luckily, I'm old enough that all my stupid things happened back in the day without digital cameras, so I don't have so much of that issue. But I mean, through footy, some of the younger mates I see online, it's like, seriously, I don't know. But maybe because everyone will do it, no one will care. I don't know. The world has changed. Actually, I mean, speaking WhatsApp, $16 billion was paid by Facebook for it. I don't even know what the hell it is. Actually, what is it? Does anyone use WhatsApp, just out of interest? Yes. Okay, obviously I'm getting old. What does it do? What?
Free chatting.
Free chatting. Right, so it's okay. MSN. Yeah. Isn't it? So Skype's kind of like, anyway. Okay, so it's kind of a messaging type service. But Facebook paid $16 billion for it. So I don't, you know, they've obviously got their reasons. I'm getting far too long in the tooth for that sort of stuff. It's like when people started telling me about Tinder. I was like, what the hell? Anyway, wasn't back in my day. So actually talking WhatsApp. So purchase Goodwill, look, this isn't a subject about consolidations. If you're doing ABC, done ABC, obviously you do a whole bunch more on this sort of stuff. But I'm pretty sure the net fair value of WhatsApp assets, liabilities, and contingent liabilities acquired was less than $16 billion. I'm just taking a punt on that. I'd imagine that's the case, which means Facebook has paid an excess for that acquisition, and that excess is your goodwill. That's basically as difficult as it's going to get in this topic. If you paid less than that, and so you've got a good deal, like the name suggests, you've got a bargain. And if you're going down that route, you need to double check that you've done the numbers correctly. And if you have done the numbers correctly, you recognize that as a gain. Now, that is a really good point to take a break. So we'll take a break at this point, come back in about 5 minutes, and talk about internally generated intangible assets. And then once we've got assets on the books, how we deal with them subsequently. And that should take us half an hour, 35 minutes or so. So intangible assets. We've had a look at separately acquired assets, and now having a look at internally generated intangible assets. And there are three main types that we're looking at. We've got goodwill, we've got research and development, and we've got brand names and various other things under that banner. Now, we're going to have a look at each of them in turn and then figure out what we end up doing with them. And goodwill, internally generated goodwill, is a fairly easy thing to deal with. And basically, you just don't do anything with it. You cannot recognize internally generated goodwill. And the reasoning for that in paragraph 49 is it's not identifiable. as we made mention earlier, if your business is going well, you've started it and you've built it up. You may not have even started it yourself, you may have bought it, but you've developed it and it's improving. The value of it is probably going to be worth more. But that value is not identifiable. You can't just sell off that to someone else. It's not separable. I don't necessarily agree with the second reason. I'm sure I can sort of understand it, but I don't necessarily agree with it, that it's not controlled by the entity. I would have thought if you're doing good things and the business is worth more, then that's sort of under your control about how you're doing. But obviously the standard setters think otherwise. Bless you. Lastly, it's not reliably measured. And I tend to agree with this a lot more. But there are certain situations where I think that may not necessarily be the case. And I'll give you an example in a second. But not reliably measurable. If I've developed my business, it's all going well, you know, I think it's worth $1 million. That's me thinking it's worth $1 million. Like I can't just go debit some sort of asset, debit goodwill, credit gain, credit OCI or whatever, just because I think it's worth more. Like I wouldn't say that's all that reliably measurable. But we've been talking about acquisitions, especially social media acquisitions and silly prices being paid for things. Snapchat. Again, yeah. What's that? Yeah, well, you can send a photo or send an image and it kind of self-destructs sort of thing, or like it disappears. Now that's all rubbish because there's programs where you can save those things, like, you know, and people do. And so just some of the things going around the place, I just don't understand. But supposedly they had something like a $3 billion offer made by Facebook to buy them. I think it was by Facebook. And they turned it down. $3 billion, they turned it down. I don't know. If it was me, you can't spend $3 billion in a lifetime. Like, you really can't. Mind boggles. But what's interesting about that from this point of view is, and I don't know, like, yes, there's issues with identifiability, even if they can determine their value. But think about it from a not reliably measured point of view. If you've had a legitimate offer put on the table for your business, that is the market saying, it may just be one person in the market, but that is the market saying, this is what we value your business at. Now, I'm not too sure if the Snapchat offer was for 100% of the business or some portion of, but let's say it was 100%. That means they have a reliable valuation of their business. Somebody's gone, it's worth $3 billion. It's not them saying it's worth that. They obviously feel it's worth a lot more than $3 billion, which is why they held out. If they internally thought that Snapchat was worth less than $3 billion, damn straight they would have sold it straight away. So they obviously think it's worth more, or they've got other things going on that they want control of it, and who knows. So I think, yeah, that holds true in a lot of cases, but sometimes when offers are made, then you may actually have a reliable valuation. But it depends on what you think, how reliable that valuation actually is. On how legitimate the offer actually was.